chart. And here's what we start seeing some, you know, huge weakness. This is really where, so the numbers are great, but then we look at someone else who's in the discount clothing store, and then we're starting to see, well, maybe Ascena is not as great of a store as we thought. So you look at asset turnover, who's the clear winner here? Definitely Ross. So when we look at asset turnover, we start seeing concerns versus its peer, as Ross has consistently, and I think we can safely say much higher ATO than Ascena. One thing, I have a tough time remembering how to spell Ascena, but and does the gap look like it's closing? Does it look like a closing gap? It's then we got a 2011, 2012, but Ross is up a little bit those 2 years. Ascena is up a little bit those 2 years. It doesn't look like there's any closing. In fact, if you go back a few years, it looked like it may actually be widening a little bit. So that's not good. I'm not going to yet say this is the most serious one because we got to look at margins, but definitely that's an issue. Now, you can, if you want to be creative, you know these stores. Anything you know, if you want to throw it in there, anything's there. I don't expect you to know these stores. I don't know enough about Ross versus Ascena to know why that might be. Why does one Ross store produce so much more revenue than one Ascena store? You know, so who knows what it is. It could be selection. It could be the disc. And we could say, well, maybe Ross is a much bigger discounter. Well, if Ross is a much bigger discounter, they'll have a higher ATO, but we should see them with a lower margin. So that's why you kind of wait till we see the margin to see what the answer is. So before we try to answer that question, let's say, let's look at at our margins. And looking at margins, we're going to look at gross margin and net margin. And we'll compare it to competitors, and then we'll talk about how does this get to revenue getting to the bottom line. So, and I think that's an important issue. If you're seeing really, really strong sales growth, but you're not seeing strong net income growth, I think you should raise that as an issue. That's great, they're getting more revenue, but where's it going? It's not going to the bottom line. It's disappearing on the way down to net income. So let's start with gross margin and see if we can look at gross margin. I didn't give you a graph of gross margin, so we'll just look at it up here. Here's their gross margin. Wow, that looks pretty strong, doesn't it? It was 40%. That's an incredible. Anytime you see gross margins gapping out more than 2 or 3%, that's pretty dramatic. This firm's gross margins went from 40% and even declined a few years. Look at these last few years. Man, they just have really jumped it up. So their gross margins at 56%. They display very strong expansion. We use the word expansion with margins. From around 40% to over 56%. This is, I mean, this is really impressive. This is very impressive. Unfortunately, I don't give you those numbers for Ross. It would be nice if we look at it for Ross, but we don't have them. But so let's look at net margin. So that's great. They're making a 56% margin is a pretty good margin for a discount dress store. So let's look at the net margin. Well, the net margin doesn't look so good. Look at Ascena's net margin. It was over 10%, then dropped down to 8%. Now it's dropped down below 6%. You look at it versus this peer. That whole argument that maybe Ross is so good at asset turnover because it's a deeper discounter, so it has higher asset turnover but weaker margins. That argument has died. So that's a huge concern. So it's like you got this really great company that's there's something wrong. There's a lot of good stuff, but there's something seriously wrong. So net margins, however, are deteriorating. And how do you spell deteriorating? That's not right. Significantly from over 10% to under 6%. And this is even more concerning given what? given its competitors' strong improvement in margins. Much research is needed to understand strong revenue and CFO growth, strong margin expansion, but weak net margins. That sounds, it gives you, some part is kind of frustrating to say what's going on in this company. Kind of exciting too to say, man, this could be a great company. There's maybe just one little thing they're doing really, really wrong that we need to fix. We can't see what it is, but my word, this is really unusual. So obviously the revenue is not getting to the bottom line. If you look at the earnings for interest and taxes, it's growing 9%, and revenues are growing 20%. That 9% earnings growth is pretty strong. 9% net income growth is pretty strong, but not when your cash from operations is growing 15%, revenues are growing 20%. So we can say as a result, the strong revenue growth over 20% is not reflected in strong EBIT growth under 10%. All right, so the question is, do you have a sense of Ascena now that you didn't have 30 minutes ago? I mean, if you had this Ascena CFO right in front of you right today, do you think you could ask them some pretty intelligent questions now that you could not have asked 30 minutes ago? And just, it doesn't take that long. We're looking at such simple high-level data, and already I'm ready to take the CFO apart. It's like, what's going on here? Come on, give me a break. All right, so let's bring those together. So to summarize, long-term growth prospects. Let's look at ATO times margin. We already know it's going to look bad, right? There's no question on that. And boy, can you find a worse chart than this? Ross and graph 3. 3 summarizes well my main concern with this company, as it is losing significant ground to its competitor, Ross. Now, this could be a situation where Ascena is doing about as well as everybody else, and Ross is just the greatest company in the world. We just don't know that. We only have 2 companies, so we're somewhat maybe partially judging them. But which stock do you think you would have rather have owned the last 7 years? My guess is I much would rather have had the Ross stock. I haven't looked at the stock prices, so I can't say for sure. So final summary. Let's look at the return on equity. Here's the return on equity. We're seeing very similar trends, return on equity. Their leverage hasn't radically changed, and the return on equity has gone from over 20% to below 10%. This firm's return on equity has declined from over 20% to under 10%. Its financial leverage is not materially different, so this is explained by the decline in ATO and margin, while its competitor has seen those increase. Main concern is both ATO and margin. It kind of gets back, I can almost copy and paste what I set up here. And in fact, once I look at it, I say, you know what, that's a better summary chart than it is. That's the advantage of doing it on a computer, right? So much research and you understand strong revenue and CFO growth, strong margin expansion, but weak net margins. So that would be a fairly decent exam if we did that. It took, I don't know how long it took me, it's 26 after. So